Hi, everyone. My name is Charles Gosi. I'm the President and CEO of the Downtown Vancouver Business Improvement Association. Welcome to our weekly webinar series, DVBIA Members Helping Members. We're so glad you could join us online today. Before we jump into our content, I'll let you know that you can submit your questions in writing today via the Q&A feature at the bottom of the Zoom window. Our presenters will be addressing your submitted questions after their presentation, but please feel free to submit your question at any point throughout. And now let's get into today's programming. Today's topic is presented in partnership with Deloitte and will cover cash flow management and financing. Leading our programming and answering your most pressing questions will be three representatives from Deloitte Canada. Managing Director of Western Canada Financial Advisory, Ryan Lang. Senior Consultant of Financial Advisory, Christy Reed. And Manager of M&A Advisory and Value Creation Services, Omar Hassani. And now, without further delay, I'll hand it over to Christy to take us through their presentation.
Thanks very much, Charles. And I'll just, my colleague Ryan's going to start off with an introduction and kind of overview of what we're going to chat about today.
Great. Thanks, everyone. So the plan here is to go over kind of my role, which is a little bit higher level, and then get into allow Christy and Omar to jump into the presentation. So. Just as agenda items today, we're going to be going over some scenario planning concepts and ideas that hopefully you can take away, cash flow forecasting, some ideas around cost reduction, as well as working capital optimization. Overlying, I guess, all of those areas includes financing and what's called external capital that might come into your business from a bank or otherwise. So, but just a quick I'm going to give a high level on let's say the Canadian capital markets, and I'll refer to what that is shortly, and how all of this COVID-19 is playing out in the capital markets. So when I refer to the private capital markets, I'm referring to the banks where BDC, EDC, private lending groups, mezzanine financing, all these terms that you may or may not have heard of, but just generally think of the outlook as in private capital markets as kind of bank financing area. And this financing area I would suggest has definitely tightened up. Pre-COVID, capital markets and bank markets, private capital markets were very liquid. They were providing lots of money into the system. Companies were able to borrow more and more money on better and better terms at lower and lower interest rates. But as COVID kind of unfolded, banks really tightened up and decided, and we're seeing this more and more, is the focus really has turned on to, rather than providing net new money to a borrower, to a company, they're really focused on their internal portfolios. That being said, that doesn't mean that you can't get any new money from a bank, as some of you probably already have through a few of the government incentive programs that have been announced. They are still lending what I would just say is on a much tighter credit basis. And because of that, the government knows that the banks are interested in providing loans where they will earn a return on that loan, and in times of uncertainty that can be challenging to predict. They realize that we need to provide financing through what they've referred to as the VCAP program, the credit availability program. So a lot of you may have heard of this. That includes the $40,000 loans that were announced that you can get through your banking relationship, and all the way up to $100 million loans, which actually were announced, I believe, last week, and probably anything in between, I should probably say. So under that program, the credit availability program, there are multiple products and financing offers that you can obtain depending on the size of your business and the need. But all of it is reliant on what I guess you can refer to as a credit-worthy borrower. And so over the next couple of minutes here, when we talk with Omar and Christy, they're going to give you some ideas around how to think about your business and how maybe the financial institutions might think about your business. So when I'm referring to credit worthiness, what I'm seeing when financial institutions or the banks are looking at providing new capital, they really are trying to provide new capital under the VCAP program, where maybe the Business Development Bank of Canada or Export Development Canada will come in and provide a guarantee to that loan so that the bank doesn't have to take on a bunch more risk. It seems like a lot of institutions are going to try and push that for obvious reasons. They would rather download, if you want to call it that, the risk to one of the other entities. So I'm going to leave it there, but really when you start thinking about, if you do, through the scenario planning, through the cash flow forecasting, cost reductions, etc., and you come up with an idea and say, I think I need some more money here. And if you haven't, gone to your bank and applied for the $40,000 loan or a few of the programs at the Business Development Bank, for example, what you really want to make sure is you understand and at least have a plan. So that you can prove that you were let's call it creditworthy pre-COVID, which means you're generating obviously free cash flow and you have some assets and things like that in the business. But you have a plan that you're executing or have executed on, and that you have an idea of your cash flow needs over the next, I would say, 12 months. That seems to be what most financial institutions are looking for. So actually, with that being said, I'm going to pass it over to Omar, who's going to lead us through the cash flow forecasting ideas and thoughts.
Thanks, Ryan. Hello, everyone. Thanks for taking the time for our webinar. I hope everyone's keeping safe and doing well. As Ryan alluded, given the situation that we're in, if your bank hasn't already, they will be, soon reaching out to you in terms and trying to figure out what your cash position is going to be. As Ryan was saying, a lot of the focus from the banks has been more on their internal portfolio side of things, and they're really pushing, their clients to be able to provide them with the cash flow for analysis of their business. And typically, what they're asking for is a 13-week cash flow. And in some cases, they're asking for a shorter weekly cash flow. So what we wanted to do is, we've been helping clients creating their 13-week cash flow. So we wanted to kind of share some best practices that we're kind of employing, some strategies that we're kind of seeing that that companies are employing as they're projecting their cash flow, and then as well as other considerations that you guys businesses should be thinking about, given that we're in a COVID type of situation. So in terms of the 13-week cash flow, there's a lot of templates that can be found online. We at Deloitte have our own, but essentially at the end of the day is what the banks want to be able to see is kind of what your liquidity is going to be on a 13-week rolling basis. So what they want to know is what are all the cash receipts that you're going to be getting into the business. And then what are the outgoing payments, and they really drill in and want to know what assumptions that you're using in each of those. So for instance, if you're forecasting revenues and as a result AR receipts, they're going to want to have visibility into what the actual revenues are, who are the customers that you're forecasting those revenues from, and then kind of how are you going to be able to collect on those. So as you're kind of putting that together, having that kind of rigor and having that sort of thought process built into your cash flow forecast is going to be critical as you go back to the banks. Another thing is to really hone in on cash only items. The banks do not care about accounting adjustments at this point, so they just want to know what cash is coming in and what cash is coming out. We've done, and I guess in this sort of situation, for most businesses, there's revenue has kind of stalemated, and there's not that much coming in, and it's mostly expenses going out. We've done seminars previously. I'm not sure if the folks on the call have sat through the tax seminar that we did, but there's a lot of tax strategies that businesses are kind of employing to try to get some cash flow through their taxes, and some of them are going back and taking the current losses and applying to previous year's income to kind of try to get recover some of the previously paid cash. There's also, we're hearing of companies applying for a deemed year end to kind of realize their losses now to kind of get back any of the payments that they might have already paid from earlier in the year. So there's a lot of strategies that we have, and we can share that with the group. But it's really kind of looking through. The revenue might be gone, but there's other ways. Taxes being one. The government programs, as I'm sure you guys are tracking, is another one. To kind of get a good handle of your revenue as well as your cost side of things. Another thing that we're seeing companies look at is really trying to figure out ways so they can optimize working capital. Christy will go through a lot more detail in how you can do that from a cash flow forecasting perspective. But at a high level, it's looking at all your AP and AR balances and accounts, and trying to figure out ways to prolong your payments to your vendors, but do it in a way where you're communicating with them, because part of this thought process has to be that you're going to come back online and you're going to have to be dealing with these vendors. So if you just ignore their invoices and don't communicate, likely as you come back online, you're not going to get favorable terms. So it's kind of having those relationships with your vendors and having discussions and just essentially working with them to see what ways you can kind of prolong the payments if you're kind of in a cash constrained situation. Similarly with your customers, we're seeing we're seeing our clients offer discounts to certain customers to try to get cash in quicker. There's also being able to factor some of your receivables out to get cash into the door. So there's looking at your working capital is another way to kind of figure out ways where you can be able to extract more cash as you're building your cash flow forecast. And then, and for the last part, I think most companies are doing a pretty good job of this, and it's just having a tight control of your cash and ensuring that there's one person that's kind of managing it, and every kind of payment that you're making, there's some critique around what the purpose is and whether it's something that can be deferred or so on and so forth. So that's kind of a high level on cash flow forecasting. Now I'll kind of roll into the second topic, which is scenario planning. We're seeing a lot of companies going into this, and it's it's an interesting topic, but I think and sometimes companies don't take this topic seriously, but it's very we're seeing a lot of benefits that companies are realizing, the ones that have actually gone through this process and have come up with have done scenario planning and have kind of like an action plan ready to go given the different kind of scenarios playing out. At a high level, what we're seeing companies do is they're creating 3 different types of scenarios, one being the best case, the worst case, and the middle case, and then all the assumptions that are kind of going into these scenario planning is, they're assessing which ones that they which they're able to control and which they can't control, that they're more external. What we're seeing companies utilize on an external basis is more of just, macroeconomic assumptions around exchange rates, oil prices, interest rates, as well as they're looking at what happened in the last financial crisis in 2008 and seeing how companies in their industries got impacted, and kind of taking those learnings and kind of building that into their scenario planning. They're also taking learnings from industries and company and competitors in regions that have kind of come out of COVID and are kind of a bit more ahead in the process. So they're kind of learning how those companies have adjusted. And we at Deloitte, we're kind of doing the same thing, where we're talking to our colleagues in Taiwan and Japan and China and so on and so forth, and taking learnings from them and putting that into our clients' scenario plans. And then also they're looking at what the customer is doing, and kind of how their customers are adjusting and at what rate. So a lot of customers are going online in different industries. So it's kind of like at what rate are customers switching, and building that into the scenario plan that the clients are creating. And yes, and I think it's, and then the important thing is kind of tracking external factors and assessing kind of how that will impact your business internally, what impact that will have on your financials, and then having a functional plan. And what I mean by that is a lot of the companies that we work with, they'll have HR, IT, sales, finance, marketing. So it's kind of like seeing what the top line impact of your business will be given the different external factors, and then determining at a functional level what you would do given the impacts in your business, and having a plan and mitigation kind of strategies for that. And then we've also been helping clients track those factors, the external factors that they've deemed to be tied to their business, and then tracking that on a monthly or weekly basis, and kind of changing your scenarios accordingly, given kind of what's happening in the market. And then just continuously refreshing your scenarios given kind of what's happening. Sorry, I've kind of been blabbering, so I'm sure you guys have questions that we can kind of get to, but I'm just being mindful that we have 3 other topics to get through. But at a high level, that's kind of what we're seeing from the scenario planning side of things, and it's just being prudent and then getting your organization ready with a plan to be able to, and then mitigation strategies to be able to execute as the different external assumptions hit the levels that you're tracking. So I'll pass it off to Christy, where Christy will kind of go through in more detail the working capital and the cost reduction that we're seeing clients implement.
Perfect. Thanks so much, Omar. So kind of to build on what Omar was talking about, there's also been a real focus on working capital, maybe because the government programs are not sufficient enough for your business. So looking at other ways to generate cash into the operations. So kind of the 3 parts of this are accounts receivable, payables, and inventory. And we're going to chat through a couple strategies that we've been seeing that our clients are using for each one. So in accounts receivable, what we've been seeing is our clients have begun repurposing or upskilling a lot of employees, especially in the accounts receivable and accounts payables groups. So what we have noticed is that if you were an employee in the accounts payable group, you're now being trained in accounts receivable. And the focus here is to call customers, focus on getting invoice collections, and ultimately, if there are collection issues, understand why they are not paying. One thing to note though, and to ensure in this climate, is that the accounts receivable invoices that you're sending out need to be accurate. And it sounds simple and business 101, but you do not want to give customers any reason to reject your invoices, especially now. You want to focus on collections. So one thing that we've been suggesting is to follow up the invoice with a phone call to your customer. Not only does this allow you to build a stronger relationship, it also creates an open line of communication and will help you identify if there's any potential bad debts or collection issues with that customer. And then if there are, an opportunity to discuss payment plans and ways to rectify that situation. Another way to look at getting cash into the business is through discounts, as Omar mentioned. So if you offer a discount today to customers to pay early, you might want to look at offering a larger discount. Clients we've been speaking to are offering anywhere from a 5% up to a 20% discount for early payment. Again, just gets business or gets cash in the door, which is, as we know, cash is king, especially now. Kind of building on the discounts, if you have clients who pay by credit card, it might also be an interesting strategy to explore waiving the credit card fee. Again, just taking down any barrier to payment. And finally, in the accounts receivable, we've seen a number of clients using factoring. So factoring is where your bank purchases your book of receivables, and then they are then responsible for the collections. Here you will take a discount on the total dollar value as opposed to if you were to collect yourself. But again, it allows you to collect cash up front and better manage your forecasts and your cash flow scenarios. In terms of payables, what we're seeing here, the overall theme is strategic selection. So mapping out your suppliers and having an open communication and dialogue with them. We've seen a number of clients who are having that difficult decision whether or not they should pay a vendor invoice. So before you do not pay a vendor invoice or decide to only pay a portion of it, we suggest doing a strategic versus non-strategic vendor assessment and mapping that out. It's probably better to have the difficult conversations rather with vendors now, because you will need them post-COVID. So burning a bridge or having negative repercussions is the last thing you want. In some cases, we've been talking to clients who made the challenging decision to not pay vendors and then were penalized with more restrictive payment terms than before. We've seen vendors impose payment terms moving from 45 days to 30 days, and in some cases, even cash on demand. So just something to be cognizant of when you're making that decision, and just trying to manage what is best for you and what your business will look like post-COVID. And then finally on inventory, this is one where looking to see what you've got on hand and how you can make the most of it. If you have any obsolete or slow moving stock, it might be an opportunity to sell at a discount or on an e-auction site if your inventory allows, depending on what you sell. We've also seen, and I'm sure many of us have seen in the news, businesses repurposing their inventory for consumer goods, PPE, safety equipment, that sort of thing, trying to make it relevant. And in speaking to a number of food manufacturing companies, we've also seen them shift their focus, maybe from food service to repackaging your inventory and selling it through independent stores or local businesses where consumers are still shopping. So that's kind of a focus, kind of very quick overview on working capital. We can get into it in more detail in the questions period. We also wanted to touch on cost reduction. So if we had been looking at this about 8 weeks ago, what we were talking about was very different than now. So 8 weeks ago, we were talking about eliminating that low-hanging fruit discretionary spending. So cutting out travel, coffees, lunches from your business, as well as strategies around personnel and employees. So working with employees to maybe take a leave of absence or reduced work hours, kind of looking to free up cash through those strategies. However, acknowledging that this has now gone on for many, many weeks, companies are having to do a deeper dive into their costs and kind of take a tougher stance. So a couple things we wanted to chat on here are fixed and variable costs. So clients are having to look at the fixed and variable costs in their business, and a lot of clients we're seeing are challenging themselves to look at this critically. So understanding which costs are fixed, which ones are variable, and the idea behind this is seeing if you can move a fixed cost into a variable cost. So an example here is sort of owning assets, leasing or renting the asset. So the opportunity to move a fixed cost into one that is purely monthly or based on usage helps you free up cash. And the easy example here is a car. If you lease a car, you can return it if you're not using it. However, if you own the car, you're forced to keep making those monthly payments and maintenance. Another example from a retailer that we were speaking to was if you have your own sales force, some are considering looking at going to a broker model, much like an insurance company. So really challenging yourself to see if you need those costs as fixed or if there's another alternative out there. And then looking at your variable costs, again, digging deep, really doing an assessment of your business, going line by line in your variable expenses and asking yourself if you need this cost going forward, and really does it tie to your future strategy, I think is the ultimate question here. If it does not, cut it out. So an example here, an easy one, much like this webinar, would be travel. So now that I think we've all gotten more comfortable with video conferencing and IM messaging, maybe employees only need to travel for critical meetings, whereas before we had a very loose definition of why you needed to travel and for what meeting. So kind of a point here is businesses need to be careful around costs, because once operations resume, costs may increase. So speaking to manufacturers, you might need to add extra shifts because of the requirement for social distancing on the line. You might be required to clean facilities, previously is every 2 days. It might now become every 2 hours, depending on regulations. And then ultimately it'll drive businesses thinking about automation, and there's a cost tied to that. So being cognizant that post-COVID business operations will change, and those expense line items will also go through a change as well. And finally, looking at cost reduction is the topic of capital expenditures. So our kind of guidance and thought here is that for any capital projects that are currently underway but are behind from a dollar or maybe timing perspective, reaching out to your partners with regard to that capital expenditure, seeing if it can be reviewed and stopped if possible. Again, just keeping cash in the business. And then of course, any new capital expenditure being put on hold until the business climate is more settled and we kind of know what this is going to look like going forward. So with that, kind of touching on what the Canadian market and what we're seeing there, and then kind of 4 bucket areas for cash flow management in the business. We're now going to open the floor up to questions, and Omar, myself, and Ryan will be available for any questions that you have and any insight we can provide.
Thank you so much for a great presentation, Christy, Omar, and Ryan. And this is the opportunity. If you have any questions, there's a Q&A box at the bottom of your Zoom screen. It might be somewhere else on your screen. If you don't mind, just type that in and I'll read the questions. So I'll go to our first one that's in the Q&A box. What are common themes or issues you're seeing from other businesses? Not sure who wants to answer that.
Sure, Ryan. Do you want to take that, or? Oh, I don't think I hear you. You might be still on mute.
There we go. Thank you. I was talking to myself, I guess. Yeah, just maybe a couple quick things. I think initially, and Chrissy alluded to this, was the idea of, people are our most important asset in many businesses, and I think everyone probably thinks that. And what do we do if we want to keep them employed? Because no one actually wanted to let anyone go. And so I think that was a very common issue amongst everyone. Number one, and then it was like, okay, we're probably going to have to let some people go. We're glad that there's a government subsidy that can kind of help with that. And then it came into kind of the legal requirements. Can we let people go? Who should we let go? Strategic questions as well. Do we want to be letting go some of our really good employees that maybe are younger but are the succession plan to the business, versus people that are maybe older and will be retiring soon? You have to make those decisions. So I think that was a big common theme. The theme now, as we moved in, there's lots of deferring of things. So for example, deferring of your payables, deferring of your loan payments, deferring of your rent, I would call it a little bit like kicking the can down the road, and in maybe a good way or a bad way, depends on, I guess, where we end up. But creating that internal liquidity so that you could stabilize the business. So I think generally speaking, that was another very common theme. How do you create internal liquidity in the business to kind of stop the bleeding, if you will? And then everything that Omar and Christy were alluding to that is now kind of going on more and more, which is kind of more this planning and thinking through the process, scenarios that could or could not, I guess, play out, and the probability of those things. I know those are challenging to do, but it's kind of a game of a thesis, and that's how I think a lot of people have to think about this. Is it's not going to be right or wrong. It's likely to be wrong, but it's being less wrong, or that's the kind of thought process around this. So if you're forecasting a 40% decrease in revenue, making sure that if you really think that that's true and you have a sound process in figuring that out, there's going to be other things that come into play in scenario planning around that. So I see a lot of companies doing that now, trying to figure that out. I think those are the two big pieces that I saw. And then the next step, the common, I guess it's maybe forecasting a bit, but we're starting to see it is now we need external money. We believe we do, we forecasted, we have this hole, if you will, of capital that we need. We're going to be running a deficit. So we need some money. And so then you're now starting to think, okay, well, how can I use the scenario planning, forecasting, and thinking through that? How do I use that information to put a package together that the financial institution is willing to accept and provide financing for me? So that is a conversation, I guess, that it's happening. It's probably we're in the early days of those things going on right now. So Omar or Christy, anything to add to that?
I would no, I think those are the two big things. I think just on the cost cutting side, I think originally a lot of the companies went in and just cut costs because they were looking at their monthly burn rate and they were just trying to reduce that as soon as possible. And in some cases, we've seen companies cut costs that were associated to revenues that weren't going to be impacted as much, and that in turn has impacted their business in a negative way. So when companies are looking at cutting costs, I think it's important to kind of take into consideration how they relate to the revenues, the different revenue streams, and understanding which revenue streams are going to be impacted more, and then finding costs associated with those and then cutting those versus just blanket cost cutting, which I think originally a lot of companies were just trying to reduce their costs. So just being mindful of that. I think we're seeing more kind of diligence around that phase, and then with companies now as they're coming out into the recover phase of things.
Oh, and that actually, that's a good point. I'll just jump on there with the idea of diversification of a supply chain, diversification of your revenue line. When you start cutting things back, you want to think of the potential unintended consequences of doing such a thing. It's all good if you can cut and do these things, but your business actually, even though that might be a good idea for the short term, because maybe cutting this supplier out is maybe the most expensive supplier, we aren't selling the product, etc. But they could be a pretty important factor to the overall diversification of your supply chain for some reason or another. And so thinking about it's okay to make the decision for the short term because maybe that's the decision that needs to be had. But thinking that how does that decision play out in maybe the medium term as well? And if we're going to cut it, how can we kind of put it back together quickly, right? So that's another thought process. Is if you're going to, it's kind of like this idea of scale. Like, it's funny, I always say this in a lot of conversations, but there's a lot of books on scaling up, and there's not so much on scaling down and scaling back up. And so thinking about how do you scale down, but for most part, the entrepreneurial spirit, you want to go back up, and you're probably going to try and go back up. So making it easier, if you will, to go back up is something to think about.
Yeah. Anything to add, Christy?
No, I think it's all very good. I think the one thing I was going to add just on the idea of cost cutting is being honest with yourself and your business around your actual monthly burn rate. So yes, you've kind of kicked the can down the road and you've deferred all these payments, but it will also take capital, to Ryan's point, to scale back up. To do marketing, to get a sales force out there, get people back in the door if you're a retailer. So being aware that yes, maybe you've got a couple million in the bank or whatever the case is, but the burn rate to get back up and running might only allow for 2 months of scaling. So just being cognizant of that and doing your planning and forecasting correctly to, as Ryan said, to the best of your knowledge, and just making sure you do have enough capital on hand to scale back up.
So just a reminder to the people attending, if you have any questions, post it in the Q&A and I'll read the question to our panelists. Then I'll move on to the next one. I've always wondered about this because I'm sure you can get a lot of stuff from the internet, but where can I get economic data for scenario planning? Good source.
So yeah, we get asked this question a lot, and I think given what's been happening, we've actually invested a lot of effort into this. So one source that companies on this call can use is actually the Deloitte economic dashboard, which is a live kind of dashboard that we've developed, which is out and it's public domain where anyone can kind of go in, and it tracks all the pretty much anything that you would need to track from, like retail spending, new home construction, whatever it may be that you deem as your key economic indicators, you can track that on a live basis. It's more on a Canada basis, and not on like a provincial or city kind of basis, but it does provide you a good indication of kind of where where things stand from a Canada perspective. Ryan, Christy, I'm not sure if there's if there's anything else that we have from like a BC or a regional level, but yeah, feel free to chime in.
Just, yeah, from my perspective, lots of information obviously online, as was alluded to earlier, but yeah, I would probably start with our dashboard. I think it does a pretty good job. Some of the information is great to forecast, for example, a revenue line or something like that, where you're trying to predict demand, which again is a challenging thing to do. But I think the idea, and this was alluded to too during the conversation, but the idea of scenario planning using economic data is around this kind of qualitative and quantitative way of doing it. So when you're taking economic indicators and things like that, it's very quantitative in nature. It's numbers, and you're trying to plan all of that out. But how did you, into your scenario planning, how did you consider the conversation with your, one of your suppliers, for example? You had a call with a supplier. You're talking about what, their ability to get you what you need. You're talking to the people you're selling to as well. How did all those things factor into your decision making? Now, it might be more anecdotal and qualitative in nature, but I think that information is probably just as valuable as the quantitative stuff that you might get from an economic dashboard or something like that.
Yeah, and I think my thought is, when you're looking at data, especially having conversations with banks and going out to seek financing, I think it's always important to have a diversified set of data points and ones where you can point to. So maybe that's looking at economic data, but then also qualitatively industry journals, talking to your suppliers, your customers, and then consumer data as well. And kind of when you're pitching to a bank or doing your own scenarios, kind of thinking critically around how all those three pieces work together, and that you're not taking just one source, you're kind of looking at it holistically. And I think one thing I've noticed coming out of the COVID scenario is a lot of quality journalism is kind of coming back top of mind. So the industry journals, business magazines, newspapers publishing a lot of high quality, reliable information that you can point to for credible scenario planning. Yeah, diversification, I think, is key.
The next question we have is, before I go to my banker, what other items should I consider?
That's a good question. So, I started off with this, and so I'll jump in there as well as a former banker myself. So the idea of, and all the conversations I've been having with other bankers, is the idea of creditworthiness. And so when I referred to this earlier is that there are a level of assets in the business. The business is producing cash flows. It might not free cash flows. It might not be producing free cash flow right now because of what's happened, but historically it was producing free cash flows. You had multiple lines of revenue, so maybe it was in a product or a service that you were offering. Maybe there's some geographical diversification there as well. Maybe you were selling into the U.S. or you're selling into another province or another city or something like that. You had a diversification in your supply chain, so you had multiple suppliers that were supplying you goods, and you can still have access to those things. You have a team of people that you've worked with. Hopefully you've had low turnover, for example, so they'll look for those types of things. And then they look at kind of the operating leverage of the business. So when I say operating leverage, Christy alluded to this, fixed cost versus variable. So that, and why they look at operating leverage is because if you have debt on the business and you have high operating leverage, which means high fixed costs compared to the amount of cash that you're generating, that means you have a very high break-even amount every month, right? Because if you have to make $10,000 a month in principal payments on your debt, and you have to make $50,000 a month in fixed costs, i.e. rent and things like that, salaries, that means you have and you only have 100,000 or 90,000 coming in. That means effectively you have to break even at a certain level, call it 50 plus 10 is 60,000. Every month you have $60,000 and call it fixed expenses that have to go out, and you're only bringing in 90. Well, if that 90 goes down, you only have a little bit of a buffer. Now, if that was a lower number, for example, less fixed costs and less debt, that has a higher cost of variable, and they would look at that as a less risky type business. That's a very kind of specific example, but those are the types of things they're going to be looking at. And usually if we're thinking on more on the smaller business side as opposed to maybe the middle market, they'll look at your personal net worth as well, right? And anyone on the line that has a commercial loan for a small business, they likely taken a personal guarantee from you, and they likely look at your how things are going personally as well. So they will look at that and figure out what does the total package look like. And if they think, and this is my understanding of what they've told me, is if they think that you were creditworthy pre-COVID, meaning they look at all these things and they say, yeah, I would give this company $100,000 or $1 million or whatever it is, then that you would be qualified for the BCAP program, and then the bank could kind of download that risk exposure for the new loan to BDC or EDC, and then they have to take a little bit of new credit exposure, so you don't need to get into the specifics, but they would then give you that money. But the idea is how were you doing pre-COVID, and then do you have enough working capital or enough cash in the bank account to get you through the next 12 months? If you don't, then that's maybe where the loan comes into play.
Anything else, Omar, Christy, on that one?
I think coming from commercial banking as well, that was my background. I would kind of piggyback on what Ryan said. Everything is very important. I'd also say making sure that you've done your research up front and help the banker or the bank understand your story, understand your business is very important. So very clear, succinct explanation of your business, what you're doing pre-COVID, why you were creditworthy pre-COVID, what's currently happened, site, industry, economic, consumer data, again, from your scenario planning. Be very upfront and clear on what your best, worst, and middle case scenario is, how you're tracking that, and then what your recovery plan is, and quantify what you need to get there. So I think being very kind of having your ducks in a row and your story supported and aligned with kind of what you can prove is very important as well, and then help them understand how they can help you.
Omar, anything to add?
No, I mean, I think Christy nailed it right there. I think that's, yeah, nothing to add there.
I'll just add on one more piece, that this idea of balancing between optimism and pessimism. The banks really, as an entrepreneur, they're very optimistic in how things are going. But the bank itself, the bank looks at it and says, well, if I give you the loan, I don't really get any of the upside of the business because I charge an interest rate and it's set at 5% or whatever it is. I only get, that's the maximum amount of return on, let's call it, my investment in this business. So because of that, kind of call it the ceiling of return on that, they say, okay, well, what are the downsides? Because I can't lose any money, right? So they're more of a pessimistic view than maybe an optimistic view. And so that's why there can be a kind of give and pull between an entrepreneur and their business and the bank willing to give them money. So it's not that one is right or wrong. It's just knowing that that's the scenario that plays out when there's the relationship, so that you can better understand maybe why a banker is saying what they're saying, to be a bit more kind of open-minded around the scenario, and then better be able to talk to them at their level as well.
I'm going to ask this next question. What are ways I can increase collections? That might be a Christy question.
Back to that one. Yeah, I think what we've been hearing from a lot of clients and that we've been speaking to is be very on top of it. Dedicate a lot of resources to it. We've seen people, move people around within the working capital group, I guess, people who used to manage accounts payable, focusing on AR. I think from a personal perspective, I think having those open lines of communication early is very important. So talking to customers, understanding where they're coming from, that also helps you with your scenario planning. Back to that, if you speak to someone, you'll get a better sense of where they're at with their business and whether you will be collecting on that in full, in part, or not at all. If it's in part or not at all, that's good to know. You want to know that up front, so that you can create a payment plan with them or find ways to work with them to collect some capital. I think factoring, if your business allows, is always an interesting option, especially now. It gets you kind of able to realize on those receivables up front and then have that cash in your business versus maybe waiting the 30, 60 days to collect it. That's all very important. And I think just the one thing, I really like that I mentioned before is once you send out an invoice, make sure it's correct, but also make sure you follow up right away with the customer to make sure they've received it. and you're top of mind on their payables.
Okay. Anything to add, Ryan or Omar?
I think one thing we've seen where historically companies wouldn't do is they're willing to take credit card payments as a form of payment from clients that they traditionally wouldn't. They do, there's a fee associated with that, but it enables your customers to kind of use another form of credit to be able to provide you liquidity. So we've seen that along with kind of what Christy just outlined.
Yeah, and just to add to that one piece, relationships matter. Relationship with suppliers and your customers really do matter. And when you think about, and this it was a kind of a thing that I used to think about is when you think about who you would pay first as your business, and you owe, like you have a payable and you owe someone. Think about the relationships that you have with those people that you need to pay, and why might you pay someone first? And it often comes down to the relationship that you have with those people, because you don't want to disappoint them. And so that same thought process, we're all humans, we're all thinking very similar, even though we're corporations, there's a bunch of corporations, they're humans that are running those corporations, and relationships do matter. So think about that and how you can utilize those to make sure, for example, you get paid on time, or at least get paid.
The next question I have is, I can't recall who mentioned this, but using brokers for sales. Are there major brokers in Vancouver that you would suggest? Are there names of companies that do that kind of work?
Yeah, I mean, that was kind of one thing we've seen with a client who's in the retail space. And we can certainly look into it. I mean, if the individual who kind of posed the question wants to reach out or kind of contact us, then we can kind of work within our network and take a look and see who our clients are using, and just kind of do a bit more research into that.
Omar or Ryan, do you have anything to add to that?
Just on my part, like you could go external and try and kind of outsource the sales side, but also kind of thinking of what a broker, or the idea of how a broker is compensated. You could try and move to that model as well, for your existing employees. For example, maybe you have some salespeople that have salaries and maybe less on their compensation is maybe more salary driven than it is on a commission basis. Maybe the offer is hey, we're really struggling here. We got to go to more of a commission-based compensation, at least over the next 6 months. We still want to give you the opportunity to sell whatever you're selling. That would turn more into like a brokerage model, and you already have the existing base. So you could potentially kind of create the model internally.
That's really good.
Is that easy to do with existing employees?
No. I would say it depends on the employees and how they think about it, to be honest. I mean, no one wants to lose their salary. I totally get it. Like, if no one wants to take a decrease in pay. No one wants to do any of that. But, if it's communicated properly, and the alternative effectively is laying people off because there are no sales, when you look at it on a relative basis and communicate it properly, I would think that it's something that you should consider.
Yeah.
Right.
Omar, did you want to add anything?
Yeah, I was just going to add, I think Christy brought this topic up earlier. We're seeing a lot of shift towards like buying local and so on and so forth. And I think a lot of some of the retailers have started to carry products that are kind of developed like here locally. So I think there's also that opportunity for a lot of businesses where maybe they might not have gotten distribution into the major retailers previously, given maybe their volume constraints. I think retailers are more receptive to that now, and I think that's another way to kind of increase your sales. I think a lot of companies are shifting online, which is the most immediate kind of action that companies are doing. But then there's also these local kind of large retailers that are looking for local suppliers that can be they can put onto the shelf. So that's also a consideration.
Christy, anything else to add?
Yeah, I think all really good ideas. I think to Ryan's point about trying to create a more broker model internally, I think the key to that might be training and ensuring that you have a business that really lends itself well to that. But if you train people properly, there is a larger upside for them. It's just kind of making sure that's communicated properly. They're trained, given the tools to succeed, and then kind of that they're doing their part to help the business as well. So it might be an interesting way of looking at it, not going external, but trying to create more of that culture internally. And then that also goes to the point of try to move your fixed cost to variable. If you can try to incentivize individuals to have maybe a lower base salary, but higher on a variable commission base, that might be an interesting opportunity in some part.
I'm going to ask another banking question. Other than the traditional banks, well, it's not quite a banking question. What other sources of financing could small businesses utilize?
Christy would be good to answer that.
Yeah, I mean, there's so many different sources of financing. I think historically we always saw that there was, the 5 major chartered banks and that was it. But I think now you've seen a lot of smaller groups come out, ones that are very specialized. Of course, there's the BDC, the EDC, and the FCC. If you're anywhere related to agriculture, kind of in that value chain, they are great options, especially now. We also see a lot of more boutique financing shops popping up who, I think from my perspective, try to get to know the business a lot more because they have fewer clients maybe. They really kind of get to understand the operations and how they can fit and how they can help. Credit unions are also a great idea. I think maybe sometimes they're overlooked, and we have some great local ones here in BC who also have kind of, I think, are moving nationally, kind of that proves their value in the Canadian financial system. I'm trying to think of what else. I mean, depending on your industry, there might be accelerator programs, grants are great. Trying to think of anything else, Ryan or Omar.
I was going to add one there, just in some of the fintech companies out there that are doing the small business loans. They usually work very quickly. There is a cost associated with speed and potentially higher, let's call it higher credit risk. So there's a spectrum of cost of capital, if you want to call it, from the cheapest being the banks, at 5 or 6 or 4% or something like that, or sometimes even less, to probably upwards of 15 or 20% interest, depending on who's providing the capital and then the risks associated with that. But Christy I think she hit the nail on the head with all of them.
Mm-hmm. I know I'm putting you on the spot on this question, going totally off script, but what are your thoughts about the federal government programs? Are they serving their purpose?
Oh, loaded question.
I know.
Yeah. So I would say that they are doing their best to serve their purpose and protect, call it the taxpayer, or whatever it is. They are they're being very tactical in the way that they're trying to deploy capital or wage subsidies and things like that. Compared to what I've seen, at least in the U.S. And some of our clients in the U.S. seems to be more of a dump the money, set the ship sail and build it as you go. The Canadian government has seemingly taken a slightly different approach, where they do announce things that there are no details of it. So when you see an announcement, there might not be any information on that other than literally the announcement that you heard. But for the most part, I think they're doing a very tactical way of doing it. They might run short. That might not be good enough, depending on the need of capital. And I think they're monitoring that fairly well. And they might need to loosen and do a few things. But, for example, with the BCAP program, where there's a splitting of credit risk, the reason they did that is they don't want the banks to issue a bunch of new loans that are guaranteed by the government effectively, and that was poorly executed or poorly adjudicated. Because, well, I'm not taking any of the risk, I'm just going to pump a bunch of money out, make a little bit of money. Not to say that the banks would do that, but you have to align incentives when you're doing things like that. And so I can see why the government would want to do that, but then there's an inherent conflict of interest as well, where as a government, you want to pump money into the system. As a bank, you're for profit, you would like to make money and not lose it. Maybe I don't want to put any money out today. Well, if you need to split it, it needs to be an 80-20. If the bank says, no, I don't want to do any more money, then the whole system shuts down because of the splitting nature of the program, right? So I guess that's my 2 cents on the money side. I don't know, Chris, or Omar, if you have anything on that.
Yeah, I think my kind of thought is the same. I think you have a bit of a dueling thing there with the government wants to put a lot of money out. The bank has a credit group, and it's hard to take that hat off because that's kind of assessing risk, and adjudication is what they do. I think you'll probably see, I think they've done, they're getting money out there. The programs, I think, are evolving, and I think that's the important part, is they're being fairly flexible. and listening that maybe things aren't working, or there's groups who need more support and the programs aren't working for those groups. And I think that's important, that they're being listening and changes have been made. Albeit it's not great, it's not perfect, but and I think also too, you just have to advocate for yourself always, use strategies that you can to keep cash in your business, bring cash in, and kind of be innovative to supplement it, because the programs might not fit exactly or be enough overall.
I have Omar, unless you have something to add, I have one other quick one that I'm going to throw out there as well. Did you have anything to comment on regarding this, Omar?
Just that, we at Deloitte, where, Ryan and I have been sitting through a lot of these COVID meetings where we're trying to help clients figure out what programs are applicable to them and so on and so forth. And I know, like, for small business owners, it might be kind of overwhelming to kind of navigate through everything that's available. So we do have a website that we've kind of set up where you can kind of put in your company details, and it gives you kind of like a list of all the programs that are applicable to you, just so if anyone's kind of interested and kind of doesn't know where to, how to figure out what programs are applicable. We have a simple kind of website that we've kind of set up, so we can share that with the group as well.
Okay, maybe I won't have time for the other question I had, so you're off the hook on that.
Okay.
We are running out of time, and we will make sure that the presentation, the PowerPoint, as well as this the recorded session, is available on our website. And I'll just wrap up and say thank you again, Ryan, Christy, and Omar, for all your great content today, and for fielding the questions from our membership. We truly appreciate your time, and a big shout out to Deloitte as well. I approached Deloitte early on in the process, probably at the end of March, to see whether or not there was an interest in helping us out with this webinar series, and there was no hesitation. They were very supportive, and I want to thank them as a company. To our participants today on the webinar, you'll be receiving a follow-up survey via email this afternoon. It's really important that we hear from you, and hope that you'll take a few moments to fill out the survey and let us know how we did today. And we also would like to hear your suggestions on future topics. We are planning to do these webinars into the month of June, maybe not necessarily weekly, but we are looking at continuing this to provide you with some information. But our next weekly webinar is next Wednesday at 2 o'clock, and we hope you can join us for the next topic. Chris Fair of Residence Consultancy will be talking about the road to recovery for the tourism sector in Vancouver. And if you don't know Chris, Chris is locally based, but he has offices in Montreal and New York City. He consults with cities and destination management organizations and other agencies around the world, and he's sought after in terms of providing his advice. So we thought it would be an excellent opportunity for Chris to share his insights about where tourism is heading in the months and years ahead. So that's it for today. Thanks everyone for joining us today, and hopefully we'll see you next week.
Thanks everyone. Thanks for joining.
Thank you.
Thanks, Charles. Thanks.
Good.